You seek out this volatility market feeling like a casino roller coaster. You see a massive price swing and jump. You think to yourself, this is the one, only just to get to completely roll steam. That gut reaction that fanatics needs to chase in action right now. It's the single biggest mistakes that blow us the whole trading account. It feels like it's the right move in the heart, but or at the moment. But trust me, it's a trap. In this video, I'm gonna give you the rock solid risk management plan to kill the impulse to your cash and start trading with the discipline of a pro. Let's be honest, we all did it, we all done it. The market is dead quiet in one moment, the other moment it's completely erupting. Stock is screaming high, the future contract is screaming high, driving off a cliff. Your heart started pounding, that FOMO fear of missing out hits you like a ton of bricks. Your brain is yelling, this is the move, get it right now, get it or you'll regret it forever. So you chase it, you buy the huge green candle or short the terrifying red one. For a split of a second you feel the adrenaline rush, but then it's all stall. In reverse, the price wipes back, smash through your entry and it hits your stop loss before you can even blink. Staring at the loss totally baffled. You just saw a monster move, so how did you end up losing your money? Because chasing the volatility is a psychological minefield. Big one. Fast move create illusion of easy money, but in actually the most dangerous time to trade. When a price move that fast, the quality of liquidations often get worse. Spreads between a bid and an ask price can widen dramatically, and your chance of getting a terrible fill skyrockets. The very act of chasing practically guarantees you're buying at the worst possible price, right at the point of a maximum risk. You're buying at the top of the impulse or panic selling the absolute bottom. This isn't a strategy, it's an emotional reaction. Fear of greed and running the show. A volatile market, fear and greed are running the show, and in a volatile market they are cranked to 11. You see a huge candle and greed screams about the chance of getting a huge profit. Second it takes us again, the fear takes over us. We either dump it for a loss or freeze like a deer in the headlights. That's not a trade, that's gambling on noise. The market is ruthlessly efficient. Well, the fallout from this mistake is brutal, and it's about more than just one bad trade. First, obviously, it torches you the trade. It torches your trading capital. Chasing this move usually means taking a bigger position because the greed is whispering in your ear. When the trade inevitably snap back, the losses are huge, leading to a painful drawdowns or even blow up your account. Your number one job as a trader is to protect your capital, and chasing is a direct assault of this rule. Second, it's completely destroyed your discipline. Every time you give it away in a chase, you are reinforcing a terrible habit. You're teaching your brain that it's okay to throw all the trading plan that you had to the trash. A solid strategy with clear rules is the only way to build consistency. An impulsive chase is a mortal enemy. It's often linked to a dreaded revenge trading, where you jump right back after a loss trying to make it all back, only to make another mistake and another more expensive mistake. Finally, the mental damage, the non-stop stress of reading that emotional roller coaster is exhausting. It leads to burnouts, crushing your confidence, and puts you in a headspace where you are consistently second-guessing everything that you do. Trading from a place of fear is a recipe for disaster. You start seeing patterns that aren't there. You are becoming too gun-shy to take the good setup when they actually appears. This is one mistake that doesn't call it this way. This is one mistake doesn't just empty your account. It drains your mental and emotional battery until you have nothing left. Okay, now that we know the problem, let's fix it. This isn't about some magical indicator that's about to build a discipline, the risk of a framework that shields you from your own worst impulse. This is how pros survive and even thrive when the market is getting crazy. There are 4 pillars for this plan. This is the most important tweak you can make. High volatility is not an innovation to bet big. It's command to trade small. Your portion size should be inversely proportional to the volatility. Simply put, when the market gets wild, your size gets smaller. Great way to do this systematically is with an average root rate or an ATR indicator. ATR just measures an asset's recent choppies. When the volatility is high, the ATR value is high, and vice versa. Practical format to use as a starting point. First, decide the absolute maximum you're willing to risk on one trade, say 0.5 or maybe 1% of the account. Next, look at the assets 14 days ATR value. Your stop loss will be multiple of the ATR, for example, 2 times ATR. Your position size is calculated as your max account divided by your ATR value add your multiples. The ATRs goes up, the formula automatically shrink your position size, keeping your dollar risk at trade consist. It makes emotion, it takes the emotion out of the size in your trade and enforce discipline right when you're needed the most. Remember, 14 days period and 2 times X multiple are just common examples. You should test what works best for your asset and timelines and time frames you trade. Second, in a choppy market, placing your stop loss too close to your entry is a recipe for getting the wipes out of a perfectly good trade. So how to fix it? Wider stop doesn't have to mean more risk. The pillar work hand in hand with the first one by using the ATR based stop, like placing it 2 times X or 2.5x the ATR away from your entry. You will get a trade where you get the trade more breathing room. This wider stop is designed to sit outside of all chaotic noise. And basically, you already cut your position size by the pillar 1. Your total dollar risk remains exactly where you planned it. You're just reshaping your risk in making it fit to a current market condition. It's crucial and to remember, however, that truly extreme move, gap risk, can cause slippage, means your loss could exceed your intended stop. The move means you get all in at one price, usually a bad one. A pro does the opposite. Instead of jumping into a full position, you scale it in by splitting it to 3, even 4 smaller pieces. Find the key entry level or a zone. Don't pile in it all in the first touch. Maybe your entry with a quarter of your position there, another quarter on another small pullback, and so this way does a few amazing things for you. It lowers your risk of getting caught in a false breakout. It's improve your average entry price, and most important, it forces you to be patient. It changes your mindset from I have to get in right now to I'll enter when the market gives me a good price. You don't need to catch the first tick of a move. You need to catch the right part of the move. The final pillar is about to protect you basically protect your entire portfolio. In a volatile market, everything can start moving together. A sudden market wild shock can take down all your open trades at once if you are overexposed. First, set the daily loss limit. This is a hard number. Maybe it's gonna be 1% of your account, maybe it's gonna be 2. If you are losing that hit number, you're done for today, period. Shut down the platform and walk away. This prevent one bad day from spiraling into a disaster. Percentage for you will depend on the strategy and the risk tolerance. For many traders, starting with a lower limit like 0.5 and maybe 1% is a smart move. Second, cap your overall exposure. When volatility picks up, reduce the total numbers of open trades you have on any given time. If you normally juggle 5 positions, maybe cut it down to 2 or 3. It's reduced the danger of collateral. The market move wipes you up. The message is simple: when the market gets loud, you get quiet. Now let's tie all this together. The first mutual mistake is emotionally chasing a huge price swing. The professional solution is a disciplined risk plan that makes you to do the exact opposite. 1. Use an ATR, automatically trade smaller when the market is wild. 2. Use an ATR-based stop to avoid getting shaken by the noise. 3. Scale your trades in smaller pieces to get better price. 4. Use a hard loss limit and a cap your total number of trades to protect your entire portfolio. In it isn't about being a hero who's trying to catch every single move. It's about being a disciplined operator who protect their capital first, so you can stay in the game for a longer time enough to win. This approach makes sense to you and you want a more strategy for trading with discipline, make sure to subscribe. New video every day, packed with practical, non-flop trading advice. And here's your homework. Open the trading journal right now and write down these 4 pillars into a pre-trade checklist that you must review. That's how you turn real knowledge into real habits. Let me know in the comments which one of those pillars you're gonna put in practice first. Trade smart, protect your capital, and I'm gonna see you on the next one.